All right, last chapter, chapter 19, accounting for estates and trusts. And so what is an estate? Well, it refers to assets owned by an individual, but for purposes of this chapter, it's actually property owned, both real and personal, by a deceased person. So when you have someone dying, owning property, whether real, personal, or both, an estate is created. And the estate consists of this property owned by the decedent at the time of their death. And so in court action, in the probate courts, what you'll see is in the estate of so-and-so, John A. Smith. And so there's a case probating John A. Smith's estate in the probate court of wherever the deceased resided at the time of their death. Probate is a state court thing, not a federal court thing. So, just to give you a little perspective. And so estate accounting focuses on the recording and reporting of financial events from the time of the person's death until all the property is distributed to whomever it's supposed to be distributed to. Now, how does property of a decedent get distributed? Well, either by will or without a will. When someone dies with a will, they're said to have died testate. And when they die without a will, they're said to die intestate. So, where those terms come from, I have no idea, but they're probably hundreds of years old. So, just kind of some free advice for what it's worth. Once you are making some money and have some property, whether real, personal, or both, prepare a will. Do some estate planning. Okay? Because if you leave family members, it will save them the grief and headache of what happens if you don't leave a will. If you want your property dispersed in a certain way, the will documents your wishes. So do some estate planning. Get it done before too long, anyway. And so if someone dies with a will, the will is the blueprint for settling the estate. It's usually pretty detailed and deals with not only how property is to be distributed, but how debts are to be paid, claims of the estate are to be settled. If you die without a will, like I said, you die intestate. there are no intentions there specified by the decedent. So what you have to do is look to the laws of intestacy in the state in which the decedent resided at the time of their death. And each state has a little bit different rules, so I can't give you with certainty what the rules are because they are different in each state. Now, they don't get into any detail, and I guess really for our purposes it really doesn't matter since we're not lawyers. They say that real property is conveyed based on the laws of descent, whereas personal property transfers are based upon the laws of distribution. Don't really know what that means, and it may mean something different in each state, but just know that there's different rules for conveying a property when it's real property versus personal property when someone dies without a will. And so the laws governing wills and estates is called probate laws. And like I said, each law establishes its own laws of descent and laws of distribution. Note that almost half of the states have adopted something called the Uniform Probate Code. But note this, that even for those states that have adopted the Uniform Probate Code, they may have added or taken away as they pleased. In other words, it may not be a full adoption. The purpose of probate laws are threefold. First, it's meant to guide whoever's dealing with the estate, whoever's managing the estate, helping them in their effort to gather and preserve all of the property of the decedent's estate, to carry out the orderly and fair settlement of debts, and to discover and implement whatever the decedent's intentions are for the remaining property. Now, just kind of give you an idea of what the probate process is like. Again, if if a decedent dies without a will or with a will, they're still going to have to go through the probate process if they own any significant amount of personal and or real property. Now, if they die with a will, that will have to be presented to the court, and the court will have to rule on whether or not the will is valid. Now, most wills, we won't get into the details of what causes a will to be valid, but obviously you may have heard that you have to be of sound mind at the time the will was created and all that stuff. So that's true, and certainly when you have a will contest, that may be an issue. Undue influence on the decedent to give a certain amount of property to certain beneficiaries might be an issue, things like that. Normally, the will is going to name an executor, that is the person who's assigned by the decedent to collect the assets of the estate and pay the debts and distribute whatever's left to the named beneficiaries. If a will has not been found, or one was just simply not made, then essentially what they have here is kind of a pecking order of who can be the administrator. So note that the term is a little different, but their job is basically the same. The executor or administrator does the same thing. They collect assets of the estate, pay the debts and claims of the estate, and distribute whatever's left to, well, in the case of no will, whoever inherits the property, per the laws of intestacy. And so again, executor responsibilities. This is also true of administrators if they die without a will. The intestate. I mean, yeah, the the decedent who dies intestate. And so their job is to take possession of all the decedent's assets and complete an inventory of the property. And that inventory has to be filed with the probate court. They have to discover claims against the estate and settle those claims. You know, normally this is done by, well, you don't know, but it's done by publishing in some legal publication notice that the decedent has died. And for all claimants to come forward and make a claim against the estate. And you have to do it for a certain amount of time, and if not, then their claims are not valid. So it's kind of an important process. Their job is also to file something called estate tax returns. And they might also have some income tax returns to file for the decedent as well. As far as estate tax are concerned, you're going to have federal estate tax as well as state estate tax returns. And same goes for income tax returns on the estate. Assuming that the state that the decedent lived in at the time of their death had a state income tax. And of course, a main part of their job after paying claims and filing these returns is to distribute property, and then finally their job is to make a full accounting of all the property, collected, settlement of debts and claims, and distribution of any property that remains after that. So what is estate property? Well, cash that exists at the time of the decedent's death. If the decedent had investments in stocks and bonds, any interest that is accrued to the date of death, any dividends declared prior to death. If there are any business investments, that's included. Any wages that remain unpaid to the decedent at the time of their death is estate property. Any accrued rents and royalties owed to the decedent at the time of death, and valuables, jewelries, paintings, antiques, collector vehicles, you name it. And so it points out that you have to give an opportunity for potential claimants against the estate to make a claim against the estate. And so, again, usually you have to file a public notice in some legal publication. You may have seen them in the classifieds before. Sometimes they're in just regular newspapers. Sometimes they're in more business type newspapers. And so usually, as the book points out, that once you publish this notice of the decedent's death and notifying potential creditors and claimants that they must make a claim, they have usually 3 or 4 months after you initiate that to make file a claim with the estate. And one of the jobs of the administrator or executor is to make sure that the claims are valid. Just because someone makes a claim doesn't mean they're a valid claim. Well, what happens if there's not enough property of the decedent to pay all the claims against the estate? Well, what you have to do is you have a certain order of priority in which claims are paid. And so that order is the following: the expenses of administering the estate. You might have lawyer expenses. You might have accountant expenses. And again, this is kind of like bankruptcy. When you have administrative expenses there, you wouldn't be able to hire people to do this work if they didn't have a first priority to the assets to get their claims paid before others. They just simply wouldn't do the work. After that, all funeral and medical expenses that are during the last illness only of the decedent, well, obviously, that relates to medical expenses, not funeral expenses, right? Debts and taxes. And it says debts and taxes given preference under federal and state laws. What that might be may vary from state to state, and certainly we're all under one federal law, so whatever that means, not sure. And last but not least, all of the claims, including unsecured obligations, credit card debts, and the like. So essentially, you know, a lot of those credit cards that grandma may have run up at the time of her death may not get paid. Well, what happens, I mean, whether you die with a will or without a will, what happens to someone who isn't a family member who's not included in the will, or doesn't take by the laws of intestacy any of the property, especially as it relates to real and personal property that they may use day to day, but actually is owned by the decedent. What if you have like a second wife or husband who doesn't own the house they live in, the decedent owns it, and courts don't want those kinds of people to be just thrown out on the street because their spouses died. They also don't want them to be penniless because their spouses died. Let's say they're a housewife or a house husband. The decedent was the working part of the duo, and all of a sudden they die, but they're not a beneficiary to the home or much of the assets, personal assets, such as the car that this surviving spouse uses. They may not be on the bank account of the decedent, and yet they need access to money and real and personal property. What do you do? Well, you have what are called homestead allowances, family allowances, and use of limited amounts of exempt property to allow the surviving spouse to continue on in the homestead and provide some minimal support during the administration of the estate, as well as use of some limited amount of exempt property, most notably automobiles and furniture, during the administration of this estate. So that's how you keep surviving spouses, and especially where they might have dependent children, in their place and supported during the administration of the estate through these allowances. And all a homestead allowance is not only does it allow the surviving spouse and children, dependent children, to stay in the house that is owned by the decedent, but it also allows for the payment of minimum payment towards the homestead as well. All right, so next thing we want to talk about is the types of estate distributions that are out there and identify the process of asset allocations and distributions from an estate. And so gifts of personal property are called legacies or bequests. And I've never heard the term legacies. Again, I come from a different state than most of you, so, you know, all the term I've heard used prevalently is bequest. So a gift of personal property to me is a bequest, but I guess in some states it's called a legacy. But either way, it means the same thing. It's a gift of personal property. All right, so you have 4 different types of legacies or bequests. And again, you can call this a specific legacy or a specific bequest, and so on and so forth. So the first type is a specific legacy. This is a gift of personal property from a directly identified source. So, gift of 10,000 shares of ATT in stock held by, whatever broker. A demonstrative legacy kind of looks like what we just talked about, except this is strictly a cash gift from a particular source. Let's say, and I think the book uses this, $10,000 in ABC Bank. A general legacy would be a cash gift, but here the decedent doesn't specify the source. So just says, I leave $10,000 to so-and-so, but does not mention where the money is at. Where the money is not at. Sorry. Proper grammar. Residual legacy is any gift of the remaining estate property. So it's a catch-all. Now, how do we distribute the decedent's estate? Well, debts and expenses of the administration of the estate are paid first. You already saw that. If funds are insufficient to satisfy all of the legacies, the ones we just talked about, the reduction of these gifts must be made and is called the process of abatement. And so you have to exhaust each of the following categories completely in one category before going to the next category to take money out of there. And so it really starts at the bottom with residual legacies, And so you start the abatement process by taking from residual legacies. All right, so X amount of money is in residual legacies. You have, let's say, $10,000 in residual legacies and $25,000 excess claims. Then you're going to have to take from residual legacies first. If you still have excess, then that money's taken next from general legacies, and so on and so forth. And so in this abatement process, you'll last take from, if you need to, specific legacies. So they're the last to suffer this abatement process. What is the estate tax? Well, the federal estate tax is a wealth transfer tax. They say here it's an excise tax assessed on the right to convey property, but what most people say is it's a wealth transfer tax. It means the same thing. And so part of the process of figuring out whether or not a decedent's estate is subject to the estate tax is determining what's in the decedent's estate at the time of death, as well as the value of the property that's in the decedent's estate at the time of death. Now it says here, real property transferred immediately to a beneficiary and not subject to probate must be included for federal estate tax purposes. All they're saying there is that certain property, and here we're talking real property, but this is true of personal property as well. If you've got a will that names a particular party, or, well, not even that. You have right of survivorship on real property. That property goes directly to whoever has that right of survivorship. Does not pass through probate, but yet still is a part of the decedent's estate for estate tax purposes. Okay, there's two good examples. This is not real property. This deals with personal property, but it really doesn't matter. I mean, there's both real and personal property usually in a decedent's estate. If the decedent owned a life insurance policy at the time of death, but named a particular beneficiary, not the estate, but let's say a son or daughter, that the proceeds of that life insurance policy pass outside the decedent's probate estate because it's made directly to a named individual, so it's not part of the probate estate, but it is part of the decedent's taxable estate for estate tax purposes. So, bottom line is the estate tax, well, the taxable estate is not always the same as the probate estate, because there's several things. There's insurance, life insurance to a particular beneficiary. There's bank accounts where you have like a joint account with right of survivorship. That passes outside of probate, but it's still a part of the decedent's estate for estate tax purposes. So you're not going to have the same numbers. And that's the point they're trying to make here. Note here, for real property, usually the fair market value for estate tax purposes is going to be its fair market value on the date of the decedent's death. There is an alternative evaluation date, which is 6 months after death, which can be used if it reduces the amount of estate taxes paid. So you have to figure out which is more beneficial to the estate, either the valuation at the date of death or valuation 6 months after. And so you have to figure out what is included in this gross estate of the decedent. Essentially real and personal property owned at the time of death. You know, all those things we've talked about. Certain gifts made within 3 years of death. Life insurance, all kinds of things. Real and personal property, you name it. Certain things reduce the gross estate. And again, this is for estate tax purposes. This is not a tax class, but this is good to know because you may have income tax to deal with, income tax owed by the estate or trust, as well as dealing with federal and possibly state estate taxes. And so items that reduce the gross estate are funeral expenses, again, estate administration expenses, liabilities, as well as losses that are incurred during the administration period, any charitable bequests that were made, something called a marital deduction, and state inheritance taxes are deducted from the gross estate as well. Now, individuals can deduct a certain amount of estate value in determining at whether or not they owe any federal estate tax. And I think in the book it talks about $5.25 million in 2015 2013, I believe in 2016, you can exempt $5.45 million worth of the decedent's estate, real and personal property. And so the bottom line is that for the most part, the federal estate tax relates to fairly affluent individuals who die. Now, that's not always true, because what's happened is, there's lots of family farmers around who are land rich and cash poor, and when they die, you've got to value the farming property at fair market value. And for some of this farmland, especially in some areas, let's say a farm around Portland. I mean, there's a lot of farms around Portland, and Portland just keeps growing and growing. And, developers want this farmland, and so the farmer dies and leaves the property to his family. You've got to include in that farmer's estate this real property at its fair market value. And so what you have is kind of a creeping value or inflation with this kind of property where, certainly for farm use, it might be at a certain value, whereas the IRS may consider it highest and best use as fair value. And so, and usually they're going to be correct, the IRS is. So what happens is that, the farmer's heirs can't pay the estate tax because it's, again, highest and best use. So they're left to sell some of the farmland just to pay the estate tax. So this isn't always about taxing the rich, although you might think it is. Now, and again, this is something we talk about in corporate tax or taxation of business entities. There's a whole chapter on federal estate tax, federal estate and gift tax. One of the things that you can help a client do along with their attorney is to make sure that they have a good plan to reduce their estate taxes if they believe they're going to be subject to them, by taking advantage of a pretty aggressive gifting program. Here it says that annual gifts of $14,000 per person can be made tax-free to an unlimited number of donees, but I think it's up to like $14,500 now. I didn't check that prior to doing this, but again, it's indexed to change with inflation, so I know it's at least $14,400, if not $14,500. But that's money that you can give away and is not included in this 5.25 or 5.45 or whatever the amount is lifetime tax-free exclusion. So you make just an unlimited amount of $14,000 gifts per person per year for several years, and then still have a federal gift tax lifetime exclusion of 5.25, 5.45, 5.49, whatever it is at the time in the year of the decedent's death. So it's a pretty good deal. And so the real point here is to make sure that you talk to your clients about giving during their lifetime so that there's not as much in their estate at the time of death. Now, on top of federal estate tax, you might have state inheritance taxes as well. And again, if the will is fairly well formed, it will specify how inheritance taxes are to be paid. And so a lot of wills specify that the inheritance taxes will be paid from the residual cash amounts. But if there's not enough in the residual to pay the inheritance taxes, then you have to look to the other recipients to contribute to the payment of inheritance taxes. Also, that's true if the will makes no specification as to how the inheritance taxes are to be paid. And then in that instance, also, the recipients of the property must contribute cash to cover the taxes. And note here, if the will makes no provision for estate inheritance taxes, the amount conveyed to each party must be reduced proportionately based on the fair value received. And so they have an example here. Says that the recipient of land valued at $200,000 would have to contribute twice as much for inheritance taxes as a beneficiary collecting cash of $100,000. So again, proportionally. Now here we're talking about something totally different. We're just talking about estate tax, that being a tax on wealth, or a transfer tax, or an excise tax, whatever you want to call it. So very subtly, they've changed here to discuss income taxation of estates and trusts. So this is a whole different topic. Estates and or trusts can be subject to income taxes. Mainly because, again, these are separate legal entities, and during their administration, they may generate income. And so, because of that, they have to pay a certain amount of income taxes. And again, they're separate entities from the decedent trust, if there is one, certainly is different from the grantor or the beneficiaries. So the estate and or trust may be subject to income tax. So any income from the estate assets, and again, this usually is occurring during the administration of the estate, is taxable to the estate. A tax return must be filed for gross income of $600 or more. And so they have an exemption on the first $600. Note that a reduction is allowed for taxable income that's donated to charity and taxable income that's distributed to a beneficiary. So essentially, in that last instance, the person who gets taxed is the beneficiary, not the estate or trust. Note that separate income tax rates are available for estate income tax or estate income. The return is due April 15th. And it says following the close of the estate's taxable year, but I would imagine most estates are December 31st. And again, this is not meant to be estate tax class. We deal with that in taxation of business entities. But at least I want to get you some idea of what that's all about. I encourage you to take the taxation of business entity class because it will really broaden your horizons as far as tax knowledge, much more so than the individual class. All right, I think this is the last thing we want to talk about, and then tomorrow or the next day, I guess, we will finish out this chapter by talking about recording transactions of the estate. And so, how do you distinguish between principal and income of the estate or trust? So, here's a couple of new terms involved with this. The recipient of any income from an estate is called the income beneficiary. And so you may have a situation where in the estate a trust is set up. Let's say the will, someone dies, leaves a will. The will creates a trust for a certain beneficiary or beneficiaries, and the terms of the trust are that a certain beneficiary or beneficiaries are to receive income from the estate or possibly certain assets of the estate. That person's called an income beneficiary. You might have in the will or trust a remainderman, which is the recipient of any estate principal. The principal is also called the corpus. And so, again, the challenge is figuring out what's income and what's principal, because depending on whether or not it's income or principal, it either goes to the income beneficiary or goes to the remainderman. And the reason why it's called a remainderman, what you may do is set up certain property, certain income generating property into a trust and say, I give this to John for John's life. The income from this property for John's life, and then upon John's death, the remainder or the principal that generated the income goes to Becky, that sort of thing. So Becky would be the remainder person, whereas John would be the income beneficiary. So it's important to be able to distinguish between income and principal is the point. Now, best way to do this is leave a will and define how income and principal is determined. If not, then you look at state law. And so the principal of the estate includes assets that existed at the date of death. These are the assets that make up the estate. Now, certain adjustments can be made because they might not actually be, they're kind of in limbo or in transit at the time of the decedent's death. So some things that may increase or decrease the principal are the following. Life insurance proceeds if the estate, the decedent's estate, is the named beneficiary. If it names a particular person, then it's not added to at least the principal for accounting purposes. It might be part of the taxable estate for estate tax purposes, but not for accounting purposes to account for principal and income. Dividends declared or other income earned prior to death of the decedent, liquidating dividends even if declared after death, debts incurred prior to death by the decedent, of course, gains and losses on the sale of corporate securities or rental property, major repairs or improvements to rental property, investment commissions and other costs, funeral expenses. And so that would be a deduction, just as some of the others are. And homestead and family allowances would be a reduction. Income of the estate includes all revenues and expenses incurred after the date of death. Reductions to income include recurring taxes such as personal and real property taxes, ordinary repair expenses, water and other utility expenses, insurance expenses, and other ordinary expenses required for the management and preservation of the estate. And so, essentially what they're saying is that certain income of the principal is included, and then from that you deduct these expenses to come up with essentially a net income amount for the income beneficiary. I mean, if there's more expenses than there are income, then there's no income coming to the income beneficiary. Now note that there are some costs that must be apportioned between the principal and interest in some fair manner, usually some sort of allocation in the decedent's will. These costs include the executor's fee, court costs, attorney's fees, and accounting fees. Why should these be apportioned? Well, because both the remainderman and the income beneficiary are benefiting from the work that's being done by these people, the executor, the attorneys, the accountants, and of course the court costs of administering the estate. So both parties are benefiting from this. So there should be some sort of fair allocation of these expenses in the will. All right, so next time we'll talk about recording transactions of the estate.